When helping families with the home care needs of a senior, we really take the time to really help educate and understand all the various factors and options. When considering reverse mortgages as a means to pay for home care, it is just as important to get a good understanding of the most important elements of those. Philip Goss is a local certified reverse mortgage professional and is a great local resource for that kind of information. So we asked Philip about some of the important information people need to know about reverse mortgages.
Well, number one, how much can we get? Obviously is one of the driving factors in making that decision. There's a qualification based upon the age of the youngest homeowner and the value of the home and current interest rates. That determines what's known as the principal limit. That's the loan amount that they qualify for. So people obviously want to know how much they're going to get and what's it going to cost them to do it. And that's always been an issue because reverse mortgages, the one that's 99% of the time utilized is a home equity conversion mortgage, which is an FHA government insured loan. Every FHA loan has what's known as mutual mortgage insurance on that loan, and that drives up the cost of it because there is a premium that has to be paid up front to FHA for the provision that insurance provides, and it makes the loan non-recourse to the homeowner, which means that basically the homeowner can never owe more than what the home could eventually sell for. So that's another one of the concerns that people have. Well, what happens if mom or dad outlive their equity? Not an issue. As long as the property remains owner-occupied and they pay their taxes and their insurance, they can continue to live in that property even though there's no equity left. And once the property needs to get sold, if it can't sell for enough to pay back what the outstanding loan balance is at that time, the lender receives the net proceeds from that sale, and any shortfall is taken care of through a claim being made by the lender on the mutual mortgage insurance pool for FHA. So the homeowner and their estate are not personally liable for paying back any shortfall on the payoff. So that insurance protects the homeowner and the estate for that particular situation. And it also guarantees that that homeowner can live in that property as long as they want, even if the property values has dropped. And let's say that there's no equity left just because the values, like it happened in 2008, the value just plummeted. Still, if the property is occupied by one of the borrowers, their taxes and insurance are kept current, they can continue to live in that property, even though there may not be any equity left, but they may have funds left in their loan that haven't been dispersed to them. They're still going to receive that money. So that insurance is important.